My name is Stephen Millard. I'm the Deputy Director for Macroeconomic Modelling and Forecasting at NIESR. I'd like to welcome you all here to the Executive Education Suite of the Cardiff Business School. We're very pleased at NIESR to be partners of Cardiff University, and these kind of events are an example of what we do as part of this partnership. What we're going to do today is we will get to the outlook for the Welsh economy, but much in the way that we actually construct the forecast, we're going to construct the presentation where we set the context. And we start at the macro level of the global economy. We then move down to the UK economy as a whole. We then move down to think about the regions within the UK. We will, of course, concentrate on the outlook for the Welsh economy. And we also go down even further to the outlook for households. So that's the way we're going to do it today. I've probably spoken more than enough already, so I'm going to hand straight over to Professor Hugh Dixon from Cardiff University and NIESR. He's the living embodiment, if you like, of the partnership between the two organisations. So Hugh, it's over to you.
Thank you very much. So first, we're going to look at the global economy very, very briefly. There's just a few main points. Essentially, the global looking at global GDP growth is slowed down quite a bit, and it's estimated to be about 3.1%, which is down from what it was. The euro area, as you probably are aware, is stagnating. Headline annual inflation rates have now fallen in most places, but not all. But underlying core inflation remains an issue for monetary authorities, and that's pretty much the same message I'll be putting for the UK. And rising bond yields, that's long-term interest rates, are put pressure on fiscal balances in the advanced economies. So those are the overall headlines. And those haven't really changed. We did the outlook 3 months ago, and it was pretty much the same then. So that's why I'm not going to say very much on that. The global situation hasn't changed much. So the one picture I would like to highlight is that where is global growth coming from? It's basically coming from BRICS plus. So if you look at that diagram, that's the quarter-on-quarter growth rates. And the black bit, which is the largest bit, is coming from BRICS plus. BRICS plus, if you remember, is Brazil, Russia, India, China, plus the new members, I think, are included in that, which is Egypt, Ethiopia, Iran, and another one. I can't remember which one, but Saudi Arabia. So that will continue to be the case, and that's obviously quite natural because there's slow growth in the Western economies. There is diversity within BRICS, of course. So there's been a bit of a shift from China to India. So China tended to be the main contributors of world growth. Now it's switching a little bit to India, but it's still that's how it is. And also in the West, the US economy is doing relatively well, and Europe's doing relatively badly. So that's all I'm going to say about the global economy. I'm happy to take questions. There's a whole global outlook on this, which goes into great detail, looking at each different group of economies and saying what's going on, which we could talk about if you're interested. So what about the UK key messages? Right. So essentially, if we're looking at the UK, headline inflation is falling quicker than expected. The Bank of England's probably going to start cutting rates in May, although there might be a bit of pressure to cut earlier. And the UK has dipped into recession in the second half of 2023. When we did the forecast, the final figures hadn't come out. They've just come out last week, which confirmed this, that we're in a recession. And growth is to remain sluggish around 1% for this year. Let's just look in that a little bit more detail. So this gives you a little fan chart, what we call. So the fan bit is the forecast. And as you move away from the black line, it gets more and more unlikely. So the dark burgundy bit in the middle, that's giving you probably where inflation is going to be. So in 2024, we see there's a big fall coming. Now, why is there a big fall in 2024? Why is there going to be a big fall? Well, it's essentially because lots of the past inflation is dropping out. It's what's called base effects. It's an annual inflation figure that covers the whole 12 months. So the current inflation figure that was announced last week at 4%. That was January to January. And as we move forward each month, a bit of inflation drops out. And in early 2023, there was very high inflation. So that high inflation is dropping out of the figure. Plus, there's an Ofgem. There's likely to be, it's probably been announced now, or is about to be announced, there's going to be a fall in the Ofgem price cap, quite significant, which will add on to that. So we know that inflation is going to drop quite rapidly to below the Bank of England target by April, but it's going to bounce back up a little bit, depending what the underlying inflation is. And we'll come back a little bit to that. Paula will be talking about that, what we think there. So there is the prospect of a bit more inflation towards the end of 2024 and into 2025. So we don't think that the inflationary problem's gone. And there's obviously a lot of upside risk that inflation might rise. There's shipping costs, oil price shocks. It's all about geopolitics. There's a lot of stuff going on at the moment, as you know from the news. And also not to forget Taiwan and the South China Sea. Any of these things, if they can have a major economic impact on supply chains and on our costs. So what about monetary policy? Well, here's a little diagram. What we expect. So we've got, we're at the peak there. 5.25 is the current rate. Coming down, we've got the markets is the dotted line. That's what the market expects to happen. So the market expects interest rates to come down slowly and eventually get to 3.25 sometime in 2026, 2027. That figure of 3 months ago, the markets thought it was going to be 4.4%, I think. But we were predicting 3.25. So it's another case where the markets have come into line with the NIESR forecast. So I think Steve's quite pleased about that. But anyway, so that's what we think. That we sort of follow that in our forecasts pretty much. We think it'll come down pretty much in line with that. And that's why we're thinking that May is the key month, although we'll see. It might come a little bit earlier. But it'll be a gradual fall. I don't think the Bank of England, it might do a signal cut interest rates by a little bit, saying, look, we're going to start the cutting cycle, but they're not going to be in a rush. Why aren't they going to be in a rush to cut interest rates? It's simply because it'd be rather embarrassing for them if they cut interest rates, then inflation shoots up for whatever reason, the geopolitical risks or other reasons, and then you have to raise them again. So I think the bank will, as I've said to them, slow but steady will win the day. They need to be slow and steady and just gradually reduce interest rates to the long run target. What about GDP growth? As I say, we predicted correctly the technical recession in the second half of 2023. So I say, when we did the forecast, we didn't actually have the figures for, sorry, I couldn't resist the smile. This is me, not NIESR, the smiley face, but there you go. And we expect GDP growth of about 0.9% in 2024, going up to 1.2% in 2025. So it's going to still sluggish growth, we predict. There's a lot of things which are holding British economic growth down. Go into that in more detail and discussion if you want to. And there seems to be a lower trend rate of growth rather than a big output gap. There's not much evidence for an output gap. So the gap between capacity, the maximum output of the UK economy and what we're currently producing, there doesn't seem to be a big output gap as evidenced by high employment and so on. And again, some of my colleagues will talk about that. And of course, there's a lot of downside risk here from geopolitical uncertainty. If things get out of hand in various parts of the world, those will definitely impact this in a negative way. Fiscal policy, I'll just change. Net borrowing is falling slowly. Now, I actually disagree with this forecast. This was snuck in without my thing, but I actually, there's a little bit of an uptick in, so if we look at 2020, it's been falling. Obviously, this is the public sector deficit. It's fallen from the pandemic level quite a lot, and it's sort of slowly going down. What you'll notice there, the black bit is interest payments, debt interest, and that's actually making up a much bigger proportion of our the deficit now. This is just the fact that interest rates are high and we have a huge national debt now. But we're actually saying the primary balance, that's the balance between government expenditure and taxation without net of the debt interest, that is turning positive. That is likely to turn positive But, you know, we don't think there's much scope for big tax cuts or big expenditure increases. There's not much fiscal space. And the reason for that is partly that inflation has fallen, and inflation has tended to have a positive effect on the public finances for a variety of reasons, again, which I'm happy to go into in more detail. Cool? Yes. I think that.
Sorry, cool. Can we do the questions at the after the presentations, because the people on Zoom won't have heard you. So we'll move on for now, but we will come back to you.
Yes. Okay, and so if we look at the debt to GDP ratio, we can see that that's falling, and it's set to fall. It's going to rise slightly in 2024-25. This is the bit that I disagree with, but it's only a little bit. So it's going to rise a little bit in 2024, but there's clearly a downward trend there. And there was quite a rapid downward trend in 2022 to 23, largely because of the high inflation, which boosts nominal GDP, which is one of the reasons why inflation is good for public finances. Okay, so what's the key messages? A repeat of them. Headline inflation is falling quicker than expected, which is a good thing, although it's possibly will bounce back a bit. The Bank of England will start cutting rates in May, probably. UK's in recession at the moment, and growth is going to remain sluggish around a lower trend rate of about 1%. So I will now move on to Paula, who's going to do a presentation in a little bit more detail about the labour market and trackers.
Morning, everyone. So as Hugh said, I'll be talking about the outlook for the UK labour market and the recent trackers. So just for those that don't know, trackers are monthly NIESR reports that we put out on the same day that the ONS releases labour market, CPI inflation, and GDP data, and we provide an analysis of the most recent data. And as Hugh sort of alluded to, these trackers came out last week, in line with the ONS releases, which is a week after the publication of our outlook. Obviously, our forecast is conditioned only on the most recent data, so we didn't have this most updated data. But again, as Hugh alluded to, we were pleased to see that the recent data releases were in line with what we had projected. So I'll speak briefly on the UK labour market. And the reason why we've separated it between Hugh's presentation and this presentation is that an important caveat should be noted about the labour market outlook in our forecast. And that is that due to issues with the ONS labour force, largely reweighting issues and surrounding population estimates, as well as data collection issues, the ONS hadn't released updated LFS data since July 2023. So the labour market picture was particularly uncertain during this forecast round. We only had experimental data for unemployment, employment, and economic inactivity. That said, we did have some information surrounding pay growth, as well as vacancies. So using that, we understood that the labour market had cooled throughout second half of 2023, and we projected it would continue to gradually cool throughout 2024, which would lead wage growth to soften back towards its historical average. So this was sort of the main pictures that we provided in our outlook surrounding the labour market. So focusing on the left-hand side graph, we can see that nominal wages were elevated by historical standards in 2023, around 6%. That said, when we adjust for inflation and adjust for type of consumption, we can see that real consumption wages actually been in negative territory due to high inflation, and the nominal wage growth really only was enabling wages to catch up to positive territory again. And when we pair this with the picture on the right-hand side, which plots corporate profit income share, we can get a picture of where this nominal wage growth was coming from. So In the media, there was quite a lot of commentary surrounding the potential for a wage price spiral, which is the idea that high wages feed back to higher prices, back to higher wages, and so on. And that could obviously be a vicious cycle. And there are various reasons why a wage price spiral didn't ensue, one of which is that inflation expectations have actually been quite well anchored throughout this inflationary surge. And again, this means that high nominal wage growth was a story of wage catch-up rather than one of de-anchored inflation expectations. And so while profit margins, really increased respective to historical levels, start of 2023, we can see that high nominal wage growth actually brought profit margins back down. And so our forecast sees these profit margins falling back gradually to their historical average, and again, nominal wage growth falling softly as well. And this essentially has enabled real consumption wages to return back to positive territory, but not necessarily see a huge boost. So that was the picture that we sort of told in our outlook. Again, it was a picture that was formed during uncertainty and with an incomplete idea of where labor market figures really were. And last week, the ONS released updated labor force survey data, which let us sort of complete this picture. So the key messages from last week's tracker essentially just confirm what Hugh has already stated. So wage growth, we now know, softened towards the end of 2023, but remains high by historical standards. Labor market continues to cool slowly, and again, wage growth will follow. CPI inflation remained unchanged at 4% in January relative to December, but this actually represented a downward surprise and might indicate that inflation will fall faster than expected throughout 2024. And GDP, while it's important to note that there was a technical recession towards the end of 2023, more importantly, the latest data actually reveals that GDP was lower in the fourth quarter of 2023 than in the first quarter of 2022. And GDP per capita, an important measure of living standards, actually remains below pre-pandemic levels. So while a technical recession can tell us about growth over 2 quarters, it doesn't really tell us much about the bigger picture. And those statistics are definitely more informative. So again, I'll just be brief about this because I don't want to repeat myself too much, but the wage tracker confirmed what we had projected. As we can see on the left-hand figure, nominal wage growth, which was particularly high in summer due to one-off payments, particularly civil service bonus payments, has fallen throughout 2023. Our forecast for the first quarter of this year doesn't see it softening that much, but over the medium term, as was sort of plotted a few slides ago, it will fall back towards 4%, 3% historical levels. And again, this is a story of the labor market loosening. So on the right-hand side, we've got the vacancy to unemployment ratio, which is an important measure of labor market tightness. And we can see that the labor market remains tight by historical levels. So plotting the recent average of about 0.5%, labor market is still relatively tight. And the differences here, I'll just note briefly, between the black line and the burgundy line represent the newly updated ONS data. So it tells us that while we were uncertain before about where we really were, the picture hasn't changed much, which is why our outlook projections so far have been consistent with the recent data release. So turning to inflation, as Hugh noted, energy prices on the right-hand side have really been driving the recent downwards trend in CPI inflation, as has a gradual softening of food price inflation. That said, services inflation, which is definitely more reflective of domestic price pressures, wage pressures, remains elevated. And that is sort of the biggest risk to CPI inflation in the medium term, because as we know, energy prices and food price decreases will continue to drive a decrease in CPI inflation. And so the left-hand side plots the headline rate in burgundy, and the gray and the blue black lines represent underlying inflationary measures, which can tell us where the underlying pressures of inflation stand. And most importantly, these underlying measures are above the headline rate. So that's consistent with a story that volatile downwards price movements have been driving a decrease in the CPI rate, but that's not reflective of where inflation really is. So in fact, when energy prices sort of finish dropping out of the basket somewhere in the middle of 2024, we might see a slight bounce back in inflation, again, consistent with our theory that the MPC will have to exert some caution in cutting interest rates because there will be or could be a bounce back in inflation. And lastly, just to reiterate my point on GDP, I think this graph sort of really illustrates the sustained flatlining of the UK economy since that initial post-pandemic recovery, and yeah, indicates that our forecast for the first quarter of 2024 does not see much change. So I'll leave you there, hand over to my colleague, Adrian. Thank you.
Thank you very much, Paula, and thank you all for hosting us. It's really great to be here. I want to just introduce our next segment, which is really the regional analysis, and then I will hand over to Anna for some of the labour market issues. So I will really just introduce the work that we do in the second chapter of our UK Outlook, where we look at the 3 devolved nations and the English regions. And here we go. And so I'll start with the key messages, which are that the low growth that both Hugh and Paula have already mentioned really is also true when you look at the UK spatially. There really isn't any part of the country that is growing at significantly higher rates than other countries, not even London. So there's also been a slowdown of growth in London. You will probably also know that London has seen quite a sharp slowdown in its productivity increase. So, you know, the problem isn't just confined to one part of the country. It is really now a UK-wide problem. We're really stuck in the doldrums. And at the moment, it's not entirely clear where any increase in prosperity is going to come from. Coupled with that are persistent disparities of productivity and living standards. So whilst the macro and aggregate picture is one of very, very low growth, of course, we have a legacy of quite big productivity differentials. So London has got a higher level, and so do the metropolitan parts of the southeast compared with other parts, but then also within regions, we're seeing differences. I mean, whether it's within London or in other parts of the country, the productivity differentials are quite stark, and living standards are no different. We have quite deep gaps, and with low growth, I'm afraid there's no catching up process. There's no leveling up, because you need much stronger growth in order for the worst performing areas to close the gap with the top performing areas. All of which is related, as we've been arguing for some time now, to chronic underinvestment. We don't have enough public investment, and we also don't have enough business investment in the UK as a whole and in the regions and localities that need it most. And this is now compounded by a lack of adequate funding for councils. So we've seen, I think now it's 8 or 9 local authorities issue Section 114 notices, otherwise known as a de facto state of bankruptcy. But we also know that that will affect public service provision, on which, of course, some of the poorest households depend most of all. So they're both spatial and distributional issues here that we cover in Chapter 2. And maybe just to share with you one thing we did in the most recent Outlook published in the first week of February, so a couple of weeks ago, some of the distribution of levelling up funds in round 3. So the total envelope is about 4.8 billion, round 1 sort of disbursement of about 1.7 billion, mostly focused on the northwest and parts of Scotland, and then other bits of money evenly spread. Round 2, the largest concentration was in the northwest, and round 3 has gone more to Scotland, Wales, and Yorkshire and Humber than previously. So we're just mapping here the allocation of the £1 billion in the third round. So there will, of course, be some effects from that over time, right? And hopefully it will make a difference, including to the places in Wales that have received funding. But of course, it will take time. This is not going to be an overnight effect. And the question also is, can it be sustained over time so that you really see at scale investment? And we have questions about this because we think the fiscal framework and the rules as they are both interpreted and applied will limit that, especially if neither of the two main parties is prepared to look at the framework in more dynamic ways. They stick to a very rigid interpretation of the rules. There's either going to be a cut of investment after the election or a cut in spending. Okay? But you can't maintain the current levels of public investment and the current levels of public spending if you leave the fiscal framework as it currently is. So that have some big, big questions in the election as to how we're going to fund public services and also invest more consistently and over longer term and at scale. So the structural gaps and persistent problems are, on the one hand, distributional, that lower income households have taken the greatest hit, both in terms of COVID and the cost of living crisis. They therefore require real wage growth. That, of course, in turn requires productivity increases that we're simply not seeing. So whilst wages are ahead of inflation, wage growth is also projected to decline. And so we're not really going to see the real wage increases that households need, especially in the bottom half of the income distribution. And if we are going to be seeing any more tax cuts, then it's not going to be an income tax cut or, an inheritance tax cut or abolition that was going to help them. It would, of course, be raising the thresholds. So again, that is a question for the budget and perhaps also for the election. Secondly, we need urgent policy action to fund local authorities more adequately. Otherwise, we're going to see more bankruptcy, more cutting back of services, higher increase in council tax. Again, the burden will fall on low-income households. House building, of course, is another main area. And then medium and long-term, reform council tax, because it's simply not working after 33 years of no reevaluation. Perhaps something like the land value tax, and certainly the productivity-enhancing public investment that we think will help unlock business investment, which is also far too low to level up the country. And on this, I shall pass the floor to Arnab, who's going to go into some more detail about Wales and the Welsh labour market.
Well, thank you very much. And it's a great pleasure to be back in Cardiff University, Cardiff Business School, and interesting times as well. Well, there's some good news. There's some cause for excitement. Falling inflation, as we have been hearing, and therefore some easing of cost of living pressures. Rising real wages, and also elections. And elections mean battlegrounds drawn up and down the country. And that leaves much space for spatial and distributional, a stage for politics to act on spatial and distributional issues. So that's an interesting situation. However, as Adrian was mentioning, we have slow recovery of living standards, particularly for low-income households whose living conditions have consistently fallen. Well, basically since the global financial crisis, but particularly during the since the pandemic hit the economy and society. There are uneven patterns of leveling up, and there's some policy urgency, therefore, beyond elections as well, and partly connected with elections. So this policy action needed to support local authorities, many of whom are filing for bankruptcy. They are in the finances are in a terrible state. And if the government does not act there, what is going to happen? Most likely, council taxes are going to increase, and council taxes are very regressive as well, as some changes to the overall tax structures in the recent times. We also suggest in terms of long-term improvement of productivity and living standards, maintaining public investment at 4% of GDP per year, while properly funding public services post-election. And there are some interesting developments there, but also from, Wales, innovative developments. Okay, all of this is to predicate the fact that, well, John Kenneth Galbraith, long time back, said, the only purpose of economic forecasting apparently is to make astrology look respectable, right? Yeah, so you all know that statement, right? Okay. That is very much true in our work, but what is also very much true is that precisely for this reason, the anchors that aggregate data provide are very important for us. And speaking today, particularly with a focus on labor markets, the problem is that the labor force survey and the labor data coming out of ONS are just not robust enough. And so that places us in a particularly difficult situation to try and interpret what is happening with respect to labor markets, on which I'm going to speak a little bit. Now, starting a little bit backwards, in terms of our overall prognosis for the Welsh economy, Welsh output is now well above pre-pandemic levels. And actually, relative to the starting point, giving the starting point at the end of 2019, so before the pandemic, right? The Welsh economy has slightly outperformed the UK economy as a whole. So the UK economy being the dotted line here, right? And the Welsh economy is the burgundy dark line, right? Okay, so that's one side of the story. Now, look at labor market uncertainty. Of course, there's uncertainty particularly compounded also by the data problems and the huge revisions in data. So this is how employment looks like. Now, we are not saying this with a huge deal of confidence. As I mentioned, we do not know which way the data will look at finally. But by and large, there are some lessons to be drawn here. So employment is not picking up quite as much as the UK economy as a whole. Of course, that has implications for productivity. So productivity looks a bit better, right? Transitions in productivity looks a bit better. Mind you, that is still way below productivity levels for the UK as a whole. So Wales has had a productivity problem. Wales also has certain issues in the labor market, right? And so even though there is a bump here, how much of that is due to current data revisions, we do not know. We'll get the picture very soon, I think in the next 5-6 months or so. But that is how productivity looks. Okay, then looking beyond these numbers, of course, as I mentioned, huge uncertainty in labor markets and the data pertaining to labor markets. There are some things which can be gleaned. And what we find from our analysis is that inactivity or a lack of economic participation rates are quite low in Wales, right? So high and rising inactivity in Wales. Here we have the numbers relative to London. Of course, London is the best performing region in the whole country, right? Compared to that inactivity rates. By the way, this inactivity here, the way we calculate at NIESR is as percentage of 16 plus population, not 16 to 64. Because increasingly, a lot of people who are older than 64 also participate very actively in the labor market. So that is how why we do this. And so this is how this looks, and it is still rising in Wales, sort of comparable to Scotland and Northern Ireland, the other two devolved nations as well. Okay, so that is one thing that we can glean from here. Secondly, higher projected Welsh unemployment over the medium run. Once again, the dotted line is the UK as a whole, so this is the unemployment rate, okay, projected. This part, the shaded part, is the projected part. These things come from the aggregate model that the National Institute runs, the NIGEM model, which Hugh was talking about, quoting from. And this is the, our projected Welsh unemployment rate over the medium run. So we can see that, Wales is the dotted line and the UK is this one. So the Welsh unemployment is higher. Where does this leave us? I think it is time for decisive policy actions, not least also because this is an election year, right? And there are some positives or some interesting insights, Welsh insights that we can draw from there. The first one that I would say is that there are ambitious priorities laid down by the economy minister late last year in this idea of built by all of us. And I think there are some positives there. There is at least some idea of medium to long run where the economy can go and society can go and pathways to take us there. So which is positive. Weak and uncertain labor markets are, of course, dampening quite a bit of that, particularly in Wales, where inactivity rate is very high, related to health, but also related to other factors, people going out of the disengaged or discouraged labor force going out of the, labor going out of the labor force. There has been some disquiet in this part of the country also on the processes of leveling up, which Adrian was talking about as well, and there have been voices raised about it. Once again, we feel that leveling up and the ambitions related to leveling up coming, as it were, very centrally from Westminster and Whitehall are good, ambitious ideas. But the process behind allocation of these funds requires quite a bit further work. And we are hoping that that will come about as more time passes on, most likely in the term of the next parliament, not this one. In Wales in particular, there is also the question of fair and inclusive, even, can I dare say, planned transition to net zero. This is particularly pertinent for Wales, being one of the wetter parts of the country. So in any case, transitions to net zero would have an impact, larger impact on households here. But beyond that, it is also on the labor force. So there have been huge projected job losses from green modernization of steel industry, which is very much in the news. All of us know this. We read about it. We witness it every day. At the same time, there are free ports which can potentially bring investments in green energy. Now, which way this pans depends on how policy interacts with, politics to try and create lives and livelihoods better. So we need to see that. So that also brings me to the point that there is need to create more good, green, and globally tradable activities. So this needs jobs and matching skills transitions. Are we ready to do it? When are we going to do it? Are we perhaps gearing up for that kind of action in the term of the next parliament? Are things that need to be seen, but maybe early signals might come over through the process of the election year, in particular manifestos, and that is what we'll be looking at, as well as the budget events. The Chancellor has apparently promised us at least 2 budget events this year. So we'll see. Right, I'll leave it there. So questions?
Thank you very much, Arnab. Thank you very much to all of our presenters. I've just spent a couple of very, very pleasant days in Portmeirion. And Portmeirion's most famous, albeit fictional, resident was always told that the questions are a burden to others. Well, we don't believe that at all. We love actually taking questions from people, so we'd very much welcome them. If you are going to ask a question, could you raise your hand first off? Neil will bring the microphone to you. If you can say your name and your institution. And I'm going to allow Cole to start, as I know he was dying to ask that question earlier. So if we go to Cole first, and then I'll try and take questions in groups of 3 if possible, and then we'll handle them in batches.
Okay, thank you very much. Working? Yeah, all right. No, probably that is more to do with my own confusion. In one of the plots Hugh was showing, there was zero principal and we were paying a lot of interest rates. So I thought that what is happening there? How come you pay interest rate when you don't owe anything? That was my question.
So the chart we were showing, this is government
Gray and black, yeah? The black
Yeah.
was interest rate payment.
Yeah, so the government deficit consists of the primary deficit plus government interest payments net. And that's what we were showing.
Oh, right, that was deficit then, not the debt.
Yeah. Deficit, exactly.
I told you, my confusion. Thank you.
No worries. We solved that one. Okay. Do we have questions, comments, thoughts? Okay, I've got one over there.
Hi, Tom Nichols, Lord Director Cymru, Welsh Government. I was going to ask a question about the medium to long run interest rate. It looks like it's flattening out at about 3.25%. In the context of that, with inflation being slightly above target, around target, that would be a real positive real interest rate. Meanwhile, you've got GDP growth, low, very low, flatlining. And I suppose just your interpretation of having that higher real interest rate compared to what we've had in the last 10 years, whereas the growth's not much different. So I just wonder what your interpretation is, or the explanation for the difference in that interest rate, nominal interest rate then, in that period, given the circumstances of the last 10 years.
Good afternoon, Robert Chapman. Just scribbled some notes on my phone. Is it relevant that GDP does not measure global warming as a negative externality when temperatures are expected to rise now, it is suggested, to 2.7 degrees with associated consequences?
Thank you. And woman at the back.
So Alison Parker from the Business School. I was just interested in Radio 4 discussion this morning about how Scotland does very well from the Barnett formula, but Wales doesn't. And given what you were talking about in terms of the need for public spending, I wondered if you want to say something about the Barnett formula, which I understand was supposed to be a one-year way of organising funding about 40 years ago.
Okay, so we have a question on R-star, we have a question on GDP measurement, and we have a question on the Barnett formula. So Hugh, I don't know if you want to tackle the first two and then Arnab the Barnett formula one.
Okay, yes, okay. So yes, so we think that the last period after the great financial crisis to the pandemic, we had near zero interest rates. That's a historical anomaly. I mean, there have been some people who've argued that long-run interest rates are falling, and that certainly there's some evidence for that. But I think the argument that if you like, the equilibrium interest rate, real interest rate is negative, is actually negative, i.e. that the interest rate should be below the inflation rate, are pretty tenuous in my opinion, although you can beg to differ. But I think we take the view at NIESR that the real interest rate will tend to be positive, so that the Bank of England's policy rate will be above its 2% target, and we think 3.25. Now, it could be a little bit lower than that. It could be a bit higher. It depends what's happening. Now, you raised the question, Tom. What's the implication for that? Well, there's a famous equation. I make sure I get this right around R minus G. So you get the rate of interest minus the growth, and if that's if the rate of interest is bigger than the rate of growth, your debt to DGP goes up. And if it's less, it goes down. Well, a real interest rate, if it's 3.25%, and the target's 2%, that implies a real interest rate of 1.25%. So that means if the growth rate of GDP is less than 1.25%, you'll tend to see the debt to GDP go up. So it's a bit of a knife edge, but I think we are seeing that we are thinking that growth will eventually come back, and it'll come back to level higher than 1%, 1.25%. But also, if you look at longer term predictions, particularly the OBR, they're quite pessimistic about our debt GDP ratio. We're not quite as bad as Japan yet, but certainly I think if you're looking in the 5 to 10 year horizon, there are a number of structural factors to do with aging populations and all that sort of stuff, which imply that the debt GDP ratio will tend to rise unless something happens. And that's another subject. But certainly in the short run, I think it's probably going to continue to go down. So I think it will go down, notwithstanding that. But I think we're not going to go back to the period of zero interest rates. So those of you with mortgages maybe ought to prepare for the fact that mortgage interest rates will remain higher. And in fact, that we recommended both in this outlook and the previous outlook that the Bank of England should give some forward guidance on this. I think just saying, well, not refusing to talk about it. And I think Hugh Pill, or was it Andrew Bailey, did once mutter or say something about interest rates being above the target, but not in any formal sense. So I think the Bank of England really should give some guidance on this, because people are buying homes, they're investing in businesses, and they need to know where long-run interest rates are going. And for people who are under the age of 40, they've grown up in a world where interest rates were zero, but that was a historical anomaly. And I don't think it'll come back, but we'll see. Does that answer your question, Tom? Yeah. On the issue of global, yes, GDP. Obviously, it's a very imperfect measure. I teach a course on economic statistics, and there have been lots of decisions about what to include, what not to include, and so on and so forth. And obviously, things like global warming and there's a very long list, but these sorts of externalities, they're not included in GDP. You can construct satellite accounts. So the ONS and other national statistical organizations construct these satellite accounts, which are outside, if you like, the official statistics, which take into account things like domestic production and various other things. So you could come up with a value for that, and that might give you something even more pessimistic than our 1%. So definitely the figures which we're quoting are the if you like, the official statistics, which don't include these factors for negative externalities, and indeed there are many other negative externalities they don't include as well. But they don't include those. And well, the Barnett formula, I'll hand it back to Arnab. But the Barnett formula, for as long as I remember, and I'm quite old, the Welsh have been complaining about this vociferously, that it hasn't been fair for Wales, or it's been very generous to Scotland. But since Arnab is based in Scotland, maybe he can give a Scottish perspective on this.
Well, you wish, Hugh, but unfortunately, the answer is no. Okay. So, what is good about any kind of formula like this is that it is sort of set in stone over a period of time. It is arrived at after some deliberation, some discussion, public debate on matters, and then it is set in stone for some time. For the process of politics and policy making to play through it. But maybe we have come to the end of that process now, and we should be thinking not only about the Barnett formula itself, but the entire fiscal framework within the whole country, together with the process of devolution. And that is something that has increasingly become more and more urgent as time has passed. How much of that we are going to get in the next parliament, I do not know. But this is something that we are anyway arguing very strongly for. So any such formula will have winners and losers. But that is not to say that the formula once arrived at should be changed every 6 months. I think it needs to be there for some time. But I wonder whether Adrian might have some views, ideas on this as well. So as our eminent political theorist.
Well, I'm certainly not sure about that, but thank you for the question. And I think, like council tax, clearly the fact that it's not been recalibrated is a huge issue, and I don't think it can stay just as it is. I think Arnab is absolutely right that policy should act as a shock, absorption mechanism, and should reduce uncertainty. So we need some medium to long-term outlook and predictability. We can't be chopping and changing policy in the way that Westminster and Whitehall have done for so long, and especially in the last few years since something called Brexit. I can't remember whether you recall, but also, of course, there's a longer history of ministerial and policy churn in Westminster and Whitehall. I mean, if you think of regional policy, industrial policy, skills policy, we've had, I think, 8 different growth plans in the last 7 years. We've had, I think, 28 pieces of legislation on higher and further education in the last, 20 years. So, there's been far too much change, far too little continuity. So policymaking needs to be more medium and long term. And I think there's much to learn from initiatives in Wales about this longer term outlook, a 5 or 10 year outlook rather than just a 2 or 3 year outlook. The other thing I would say is that besides the Barnett formula itself, we do need to think about fiscal devolution. Can we actually decentralize certain decision-making powers and resources, and not just have this top-down approach that we've had for too long in the UK? And coupled with that is the question of how we would do tax and spending, in a more long-term way. Are there other forms of taxation we should consider? We've done some work at the National Institute on progressive consumption taxation, so taxing consumption rather than just income, or changing the whole way we think about taxing consumption. Of course, we do so already, but there are other ways of doing this. I mentioned land value tax. There's all sorts of things that need to be considered. We cannot just stick to the current model, because that model does not work for large parts of the country. And even the parts that are doing well, London, the metropolitan parts of the southeast, we can see the slowdown in growth. We can see the fact that productivity increases have again sharply slowed down. And the question really is, where is that growth coming from, both in quantity but also in quality terms? The kind of sustainable growth that we do need. And we cannot rely on London and the metropolitan parts of the southeast as a kind of growth engine of the whole country. That trickle-down model doesn't work. We need to build up a lot more economic critical mass around the country. And that can only happen through investment, both public and private. And the current tax and spend approach doesn't seem to favor investment nearly enough. There have been some very welcome moves in recent times. We commented at the time that we were in favor of full expensing, and not just for a period of time, but indefinitely, because it creates that certainty, that predictability for business. But these are all fairly small initiatives. We need much, much greater scale of investment. And that's, I think, is the big question for not just this year, but for the election, for the next parliament, but also for the devolved nations, generating that investment and that growth.
I think you had wanted to come in.
Yeah, I'd really reiterate that. But I think there's a real need to reconfigure the fiscal devolution mechanism. And just to give you one very simple example, in both Scotland and Wales, there's been very strong push, or there was a very strong push for universal basic income. And of course, because the welfare state is set at the UK level, you just can't do anything, really. It's very difficult for the devolved nations to do anything. And I think, there are other initiatives that could come about simply because of the different political economy in different parts of the UK. That's something which I think needs to be really thought about. That was all.
So I've got a question from Robert. Before going to you, I was just wondering if there were any questions online. And I should have said this up front for our online attendees. If you have any questions, either put them in the chat or feel free to raise your hand. We can actually see hands, so we should be okay. I think there's somebody clapping, actually, rather than raising their hand. But Neil's waving at me now.
Got one question online.
Okay, we have one online question. We'll take that, then we'll come to Robert.
Okay, so the question is from Leighton Jenkins from the CBI in Cymru. If one day you woke up as First Minister, what policies would you prioritise to grow the economy?
Fantastic. Well, we'll come to that in a minute. Policies to grow the economy, that's basically everyone, I think. Robert.
So, yeah, I should just say strategic property advisor. To be fair, Hugh, you didn't answer my question. I know that GDP does not include any reference or take cognizance of global warming. My question was, is it relevant that it does not take cognizance of global warming when there are consequences and impacts? But just as a quick follow-up, if I may, in terms of, if you like, the well-being and a well-being of Wales and perhaps a more thriving Wales from an economic point of view, should there be a greater focus? And I think the point's been made, to be fair, on subsidiarity, which is very much around devolution, greater devolutionary powers, and greater borrowing. So, for example, infrastructure, the ratio, and I quote Professor Mark Barry here, in terms of infrastructure spend between the Southeast and Wales is 200 to 1.
Okay. Both very good questions. We'll come onto the policies for a minute, which should include this whole subsidiarity issue and infrastructure spending. I mean, I'm going to paraphrase what I thought Hugh's answer was. GDP doesn't take account of all sorts of externalities, one of which is global warming. Clearly, if you want to measure of well-being, it should do. I don't know if that answers the question or not, but I mean, is it still relevant? Well, it's relevant for what it measures. I mean, it's a measure of the economy's total output. You know, if you want to measure of that, and GDP's I should say actually, it's a measure of the economy's output that is traded in markets as well. So it clearly doesn't take account of household production, which is very, very important. But yeah, I mean, it's as relevant as it's always been. There have always been problems with it. There are always things that we think should be included, shouldn't be included, etc. But you know, it is what it is. And as you said, I think the ONS have made a marked effort, and indeed, both Cardiff and NIESR have been involved via our membership of ESCO, which again came out of the partnership between the two institutions. ESCO is the Economic Statistics Centre of Excellence, who have a whole big project in conjunction with the ONS called Beyond GDP, where they are trying to tackle precisely these issues. Okay, so that's given people hopefully time to think about what they would do if they were the First Minister.
I'll just come back to that question. Sorry. Yes, I did misunderstand you. You're saying, is GDP relevant? Yes, I think it still is relevant because it measures part of an important thing. And I'll just give you the example of the United Nations Human Development Index, for example, which is another measure. It's an old measure. It doesn't take account of global warming. But, you know, you look at life expectancy, education, and GDP. So, yeah, you can look at wider measures, but I think it's difficult to get rid of GDP completely, because, you know, that's basically our standard of living. Most of GDP is wages and other income, and that's what we get. That you know, it measures that, and that's an important part of what's going on. Well, I think Adrian's probably the best person to pass as to what he'd do if he was the successor to Mark Drakeford.
Well, that's very kind, and I suppose I would say I don't think there's any one policy measure that will suddenly change the fundamentals overnight. There isn't a quick fix. There isn't a magic wand you can just deploy in order to move from this low growth and low investment and in many sectors still low wage equilibrium to a higher one. So I think the point to make is not to focus on any one policy measure, but to look at it in the round and see, what is the strategy over the medium and long term. But of course, that is a very academic answer, and it wouldn't satisfy the political or the policy debate. I suppose if you were to look at policy measures to try and change things, again, I come back to the fiscal framework. I think it would be the First Minister, together with others, making representations and saying that unless public investment can be maintained at the current level of 4% of GDP per year, and there's not going to be a massive change after the election, we are simply not going to be able to do the things we want to do, whether it's leveling up, whether it's a transition, whether it's other ambitions that either the country as a whole has or particular parts have. So I would lobby for a very sober look at the fiscal framework, acknowledging that fiscal rules are important instruments of predictable policy making, that you don't want debt and deficit to get out of hand at all, just like you don't want inflation to get out of hand or any kind of bubble that will burst and create a massive problem further down the line. But you don't want to be beholden to debt and deficit levels in such a way that you cannot invest, because it's simply a straitjacket in which we're going to be locked for no other reason than not thinking ambitiously and creatively about how to conduct fiscal policy. And of course, we've also made the point at NIESR that you need a good coordination with monetary policy. And monetary policy is the remit of the Bank of England. It is the bank's job to control inflation and to work towards financial stability. But of course, the two interact. And so once you have a sense of where monetary policy is going and the bank communicating in a forward-looking manner, point that Hugh and others have made, we need that communication from the bank. Then, of course, it's up to fiscal policy to address the supply side and also to think how supply and demand will interact. So I would simply say the job of the First Minister, whether it's here or in Scotland, and indeed now that the devolved government is back up in Northern Ireland, is to make clear to the centre what the needs are. And I don't think we can expect Scotland, Wales and Northern Ireland to solve an issue that also requires central coordination. So the job really is one for Treasury and one for central government in close coordination with devolved governments, because we have to get investment much, much higher than it is. Business investment has been poor by both historical standards and by international comparison. Public investment until recently was much too low. And how do we maintain much higher levels of investment in the public sphere, unlocking business investment where it's required? Arnaud mentioned the free ports. There are all sorts of interesting initiatives, but they're not connected. They're disjointed, fragmented, and simply not at scale. And it's a job for central government to do that coordinating bit. That would be my answer.
I would add to that, when I'm going to the Treasury to get them to sort out public investment, to do something about Robert's issue, that public investment all seems to go to London and the Southeast. That clearly needs to be changed. I have a question at the back, I believe. I have two questions at the back, I think.
Yeah, sorry, just it's not my question, but in terms of alternative economic indicators, politicians don't like them because they always go down. As a rule, GDP sometimes goes up, but my question is a bit more parochial. There was one of the figures that Arnaud put up on the Welsh economy that I think had Wales progressing faster than the UK average in terms of GVA per labour hour in the period to 2025 Q1. And I'm just wondering what the mechanism is, given the problems that we have, and of course we have real pressures now in some of our more high productivity elements of our manufacturing sector are starting to disappear. I was just wondering what the mechanism, why we might, if I've understood that chart correctly, why we might be doing better in terms of growth of GVA per labour hour over that period.
Thank you. And did you have a question? Oh, Cole has another one.
I'm just wondering, it appears that America is sneezing. Why we are not catching cold?
I'm not sure America's sneezing, actually. I was at a conference in San Antonio in January, and it was quite funny because the people were saying that, everybody in America thinks times are really tough and really bad and whatever. But actually, if you look at any kind of standard measure of how well the US economy is doing, it's doing really well. Massively better, in fact, than people were expecting. So I think the real issue is, as you say, why aren't we growing with it? Maybe, but I don't know the answer to that. But I'm sure our panelists will come up with it.
So we have always been told that US is the largest economy in the globe, and if America sneezes, Europe catches cold. So America is growing. What's the problem with the Europeans?
That's a good question. I'll allow someone to tackle that in a minute, but Arnaud, if you want to take the other question first.
Yeah, so that is GVA not per labor hour, that is GVA, real GVA. That's number one. Number two, question is that, yes, like everywhere else in the country, the pandemic and the Brexit shock has affected the Welsh economy and society very hard. But perhaps it has affected certain other parts of the country a bit harder. So in that sense, so the recovery in Wales from the COVID shock and followed on by Brexit has been slightly better than the UK as a whole, which is not very good in itself, right? So that needs to be put in place. The other thing which has happened, which drives these numbers, is the ONS suddenly, sometime back, finding, what was it? A lot of money behind the sofa. So GDP numbers have been revised. And there is a slightly larger allocation of that in Wales. Why is that the case? Because manufacturing in Wales built up quite a bit of inventories, and this was largely due to inventories. It was adjusting for inventories during the COVID period. So so combination of those is what we are seeing, what you saw in the chart there. Thank you.
Yes, to answer Cool's question, why is there a divergence between America and Western Europe? It's largely, I think, due to the differential impact of the war in Ukraine. So in the following sense, firstly, energy. America is now the main supplier of LNG to Europe. So there's been a switch, if you like. Europe switched away from getting stuff from Russia, and it's getting it from America now. So that's a big boost, if you like, to US energy exports. That's one fact. And secondly, of course, the military expenditures has gone up in the US as a result. So in that sense, the impact of there's been a positive impact along with negative impacts, but there's been a positive impact on the US economy. In Europe, it's been really just negative, particularly given the fact that Europe, particularly Germany, just because we're nearer, we tended to trade a lot more with Russia. The continental Europe did, at least. So that obviously with the sanctions and since the invasion of Ukraine by Russia, that's tended to impact much more on Western Europe than it has on the US, which is much more diversified, if you like. It hasn't really had much impact on America. I don't know if anybody else think any more to add on that.
Ella?
I was just to add to Hugh's point that another big difference that we've witnessed between the US and Europe since the onset of the COVID pandemic is really the ability to stabilize in the face of the pandemic shock, really. And we know that fiscal stimulus and monetary stimulus in the US was of an order of twice, 3 times the magnitude of Europe, even more so than in the UK. And that's simply because they could. For instance, the first demand stimulus package, the CARES Act, which was one of several, amounted to $1.2 trillion. And that gave every single household a check, a sort of an unconditional check to spend money, right? So that's just to say that, the story of the US post-pandemic is also one of the government's ability to stabilize that initial shock in a way that, both governments and central banks, obviously QE as well in the US was enormous post-pandemic. The Fed's balance sheet expanded to some $9 trillion. So that's just to say that these are nuances that we need to take into account when we make these comparisons. And one thing we've been talking about at NIESR is looking towards the future. We know that in the last few decades, there's been an increased concentration of shocks by historical standards, and looking towards the future, that might be the case as well. And we might start to see these divergences between countries or geographical groups even widen, because there will be this divergence in government ability to, say, provide fiscal support in the face of negative supply shocks or demand shocks or whatever it may be.
Thank you, Bella. Any more questions? I know we're now sort of edging towards lunch, but we still got a bit of time if people have questions. I'm not seeing any online either. Sorry.
Sorry to keep everyone from lunch. Just the data on productivity in Wales is very interesting, and Wales is commonly seen as having very low productivity. It might just be being confused, but does that data include public sector productivity? And if so, are you relying on the ONS's experimental statistics around public sector productivity to calculate that? Wales is a very high public sector and so very dependent on public sector for a lot of employment. So is that skewing that figure a little? I don't know. Perhaps you could explain.
Straight up. Yeah. Yes, it includes public sector. It does include public sector. And the way this is calculated is output per labor hour, including the public sector, yes.
The fact that it includes the public sector, the fact that Wales has a higher than average public sector means you'd expect it to have lower than average productivity for that reason. And you particularly see that actually in Northern Ireland, where something more than half the economy is public sector. Fantastic. That seemed a nice little thing to close. Oh, Robert's got one more question. Okay, if it's quick.
It's very quick one.
We love questions. I said that earlier.
You did invite it earlier on, so it's very quick, and it's with a smile on my face. Could you please explain to me the difference between a recession and a technical recession?
Paola, do you want to tackle that one?
So a technical recession constitutes two consecutive quarters of negative GDP growth. And a recession more broadly, as we like to think about it at NIESR and as other institutions such as the National Bureau of Economic Research in the US have adopted, and recently the Financial Times have adopted this definition of recession as well for when they speak of recession. So it's not just us, is what I'm trying to say, is a sort of sustained decrease in economic output spanning more than 2 quarters and without so much a focus on the short term, but rather the medium and longer term. So I guess that sort of comes back to the point that you were making about economic statistics and their limitations. And, we think that technical recessions is
depth and duration, Carl. And at some point there's got to be judgment applied, which is why the NBER rely on the judgments of essentially 4 individuals to decide whether it's a recession or not. But I think what's fairly clear is that we had a technical recession in the UK, but actually what we should be worried about in the UK is the fact that we haven't grown in a few years. So zero growth. It wouldn't be a recession because we haven't seen the big drop, but we've had zero growth now since before COVID, in essence, and that's what we should be worried about.
So, I might just add, I mean, this idea of a technical recession, zero growth, negative growth for two quarters. I mean, in the past, when economies were growing quite rapidly, 2% per year, zero growth was quite a bad outcome. But obviously, if you're only growing at 1% or flatlining, it doesn't really make much difference. So it's just an arbitrary definition which people have. And the real idea of a recession is that something bad is happening. And what bad means, people say about the Chinese economy, oh, it's only growing at 4% per year. This is a really bad outcome for the Chinese economy. Oh, we should have that here.
Fantastic. Okay, I think that is probably a good point at which to break for lunch. Again, I'd like to thank, in particular, Cardiff Business School for hosting this event and for the ongoing partnership they have with NIESR. I'd like to thank all of the panelists who basically presented our outlook much more effectively than I would have done, that's for sure, and indeed answered all the questions much better than I would have done. And most importantly of all, I'd like to thank our audience, both online and I was about to say in the studio, no, in the business school. Thank you very much for coming along. It's you, the audience, who actually make these events worth doing. So thank you very much.